Every empire tells itself the same story. This time, we have broken the pattern. In the 1600s, Dutch merchants built fleets that circled the globe. 2 centuries later, British factories ignited the Industrial Revolution. America laid coast-to-coast railways and wired the world. But beneath each golden age, the seeds of collapse were quietly sown. Why do history's greatest powers keep falling into the same 7-stage trap? And could it already be starting again? Here is how boom and optimism flip, stage by stage, into leverage and fragility. In Amsterdam, 1602, a group of merchants pooled their fortunes to launch the Dutch East India Company, the VOC. Within a generation, their fleets reached every corner of the known world. By mid-century, Amsterdam's harbors bristled with ships returning from Asia, their holds stuffed with spices, silks, and porcelain. Warehouse ledgers show trade volumes doubling and redoubling. Payroll lists from the shipyards name hundreds of craftsmen, each racing to outbuild the last. The city's population soared, and for the first time, ordinary investors could buy shares in a company that spanned continents. In less than 50 years, the Dutch Republic became Europe's primary trade hub, handling more cargo than London, Venice, and Lisbon combined. A century later, the British Empire found its own engine of growth. In the late 1700s, steam engines and mechanized looms turned raw cotton into mountains of cloth. Manchester's mills, powered by Bolton and Watt technology, ran day and night. Factory records show productivity doubling between 1780 and 1830. Skilled workers saw their wages rise, and city populations exploded. Canals and turnpikes stitched the country together, funneling coal and iron to the new industrial heartlands. For the first time, Britain produced more manufactured goods than any other nation on earth. The optimism of the age filled newspapers and parliamentary speeches, promising a future of endless progress. Across the Atlantic, America's transformation began with steel rails and telegraph wires. By 1869, the last spike of the Transcontinental Railroad joined the coasts. In the decades that followed, U.S. real GDP per capita quadrupled. New cities bloomed along the tracks, and goods moved from farm to factory to port at speeds unimaginable a generation before. In the 20th century, Bell Labs and Silicon Valley carried the torch. Microchips, satellites, and the internet redefined what productivity meant. Each breakthrough brought a fresh wave of optimism and investment. From the VOC's sea routes to the British mills to America's digital highways, real expansion always started with concrete inventions, rising output, and a sense that anything was possible. But as history shows, the very success of these systems set the stage for the next, more dangerous phase. Stage 2. Credit boom. In the wake of explosive growth, financial innovation takes center stage. Amsterdam's merchants, flush with trade profits, needed a safer, faster way to move money. In 1609, the city opened the Bank of Amsterdam, offering a stable currency backed by deposits of gold and silver. For the first time, merchants could settle debts across Europe with a simple ledger entry. No need for risky shipments of coin. The bank's records show balances doubling within a few years, as traders and companies like the VOC relied on its credit to finance ever larger ventures. Directors debated how far to stretch the rules. Some warned about loosened collateral standards, but the hunger for growth won out. Credit flowed more freely, and the bank quietly extended large loans to the VOC and city government, building hidden risks into the system. Britain's boom brought its own credit revolution. By the early 1800s, joint stock banks and new securities markets unlocked vast sums for railways, factories, and trade. The repeal of the Bubble Act in 1825 let companies sell shares to the public with few restrictions. Bank ledgers from this era reveal a surge in lending, often against railway shares as collateral. Investors could buy shares on margin or in installments, controlling large positions with little cash down. Parliamentary records from the 1840s show more than £200 million, over a fifth of Britain's gross domestic product, committed to railway investments. Bank of England balance sheets track a sharp rise in lending, even as concerns about risk were brushed aside in the name of progress. In the United States, the late 20th century saw credit innovation reach new heights. Securitization allowed banks to bundle mortgages and debts, selling them off to investors around the world. By the early 2000s, shadow banking, non-bank lenders, and off-balance sheet vehicles handled trillions of loans and securities. Federal Reserve data shows U.S. private and public debt climbing from 150% of gross domestic product in the 1950s to over 350% just before 2008. Cheap interest rates fueled borrowing by households and corporations, while complex derivatives and mortgage-backed securities disguised the true level of risk. Credit became the engine of growth, but the link between lending and real production began to blur. Financial institutions, once tools for trade and industry, now sat at the heart of the economy, powerful, profitable, and increasingly untethered from the world of ships, mills, or microchips. The stage was set for speculation to take over. Stage 3. Speculation. In the winter of 1636, tulip bulbs in Dutch taverns changed hands for prices higher than a skilled artisan could earn in 10 years. Notarial records from Haarlem list contracts for single bulbs fetching over 5,000 guilders, enough to buy a canal house outright. Pamphlets circulated promising fortunes to anyone bold enough to stake a claim. Merchants, brewers, and even chimney sweeps joined the frenzy, convinced that rare colors and new hybrids would never lose their value. The language of the time was breathless. Letters from traders describe a new age of prosperity and the miracle flower that would enrich all who dared. But few stopped to ask what a tulip was actually worth outside the fevered market. 2 centuries later, the British railway mania followed a similar script. By 1845, promotional circulars for new railway lines arrived daily in London and Manchester. A single share in George Hudson's companies could be flipped for a quick profit, and newspaper advertisements promised guaranteed returns. Parliamentary records show that more than £220 million, over 20% of Britain's gross domestic product, was funneled into railway shares, much of it on margin or installment. Investor letters from the period boast of lines drawn on maps and fortunes counted before a single sleeper was laid. Even as costs soared and rival schemes overlapped, the belief in a railway revolution drowned out warnings from skeptical bankers. Prices for railway shares doubled, then doubled again, as crowds packed shareholder meetings to demand ever more ambitious projects. In modern America, the late 1990s dot-com boom made speculation a public sport. The Nasdaq rose to 5,048 in March 2000, fueled by initial public offerings for companies with little more than a website and a press release. Promotional material from Silicon Valley promised the end of old business models and the dawn of a new economy. Day traders, flush with margin loans, chased stocks that doubled in a morning and crashed by afternoon. Venture capitalists and analysts competed to outbid each other's projections, while investor chat rooms buzzed with rumors and tips. The logic was always the same. Technology had changed the rules, and this time, the sky was the limit. In each era, promoters and speculators insisted that they had discovered a new source of value. Price charts from tulip bulbs, railway shares, and tech stocks all show the same vertical climb, detached from any measure of real worth. The language of a new era turned risk into opportunity and blinded even the cautious to the dangers beneath. As the euphoria built, few could imagine the reversal waiting just ahead. Stage 4. Crisis. In February 1637, the Dutch tulip market unraveled in a matter of days. Buyers refused to honor contracts at auction, sellers defaulted, and the courts offered no help, treating most deals as unenforceable wagers. Panic spread as word traveled from Haarlem to Amsterdam. City council minutes from March record emergency meetings, while pamphlets circulated warnings of ruin and shame. The Bank of Amsterdam, already stretched by secret loans to the Dutch East India Company, known as the VOC, and the city government, watched as deposits drained and its reserves of silver and gold fell by nearly a third. Merchants rushed to withdraw funds, fearful that the bank itself might fail. Trade in VOC shares nearly froze. The financial machinery that had powered decades of prosperity ground to a halt. leaving even the wealthiest families unsure who would honor their debts or contracts by the week's end. 2 centuries later, the British Empire faced its own reckoning. In the spring of 1847, the Bank of England's gold reserves began to vanish. Investors, spooked by collapsing railway shares and rumors of bank failures, lined up to convert notes into coin. Weekly returns show reserves plunging from £5.5 million in June to just over £3 million by October. The bank raised its discount rate to 8%, but the withdrawals only accelerated. Parliamentary debates grew heated as members of Parliament demanded answers, and the Times ran headlines about a great panic. By late October, the Bank of England was forced to suspend the rules of the 1844 Bank Charter Act, issuing new notes without gold backing to keep the system afloat. For weeks, confidence hung by a thread. Banks failed. Companies went under, and the city's usual order dissolved into confusion. In 2008, while Wall Street's crisis played out in real time, Lehman Brothers, once among the most respected names in finance, filed for bankruptcy after a weekend of failed rescue talks. Federal Reserve transcripts capture the urgency. Tim Geithner warned of systemic risk across the board. Within hours, money market funds broke the buck. Interbank lending froze, and global credit markets seized up. The Federal Reserve and the Treasury scrambled to contain the fallout, but the damage spread with shocking speed. Trading floors went silent, and some of the world's largest financial institutions teetered on the brink. Phone records and emails from that week show confusion, fear, and desperate last-minute lobbying for help. In each era, the collapse came suddenly, as trust vanished and the promise of endless growth gave way to a scramble for survival. The pattern was unmistakable. Confidence, once lost, could not be restored by words alone. Only decisive intervention could prevent the panic from dragging the entire system down. Stage 5. Bailout. In the aftermath of financial panic, the burden of rescue shifted from markets to governments. In Amsterdam, in 1782, city ledgers record a massive emergency loan. Millions of florins advanced to the Dutch East India Company and to the city itself. The funds come from forced loans levied on wealthy citizens, their names entered into council minutes, and a promise of future repayment. As losses mount, the city's finances grow fragile. Bank of Amsterdam directors debate how much more to lend, but the expectation is clear. When crisis strikes, public money will be used to stabilize the system, even if it compounds future risk. A century later, London's bankers face their own reckoning. In 1890, Barings Bank teeters on the edge of collapse after bad bets in Argentina. Bank of England minutes from November show a flurry of late-night meetings, governors, treasury officials, and city bankers hammering out a rescue. The solution is a guarantee fund. Private banks pool resources to cover Barings' debts, while the central bank provides emergency liquidity. The immediate panic subsides, but the underlying lesson is unmistakable. The largest players can count on collective support, and moral hazard grows with every intervention. In modern America, the same dilemma plays out on a larger scale. In October 2008, Congress authorizes $700 billion for the Troubled Asset Relief Program, TARP. Congressional records capture fierce debates over executive pay, taxpayer risk, and the fairness of saving failed institutions. The Treasury injects capital into major banks while the Federal Reserve absorbs toxic assets from balance sheets. The crisis is contained, but the cost is a new mountain of public debt and a system more reliant than ever on official rescue. Each bailout protects the core, but shifts risk from private hands to the public, and it sets the stage for a long era of slow growth and unresolved debt. By 1720, Dutch trade had slipped behind England's. Madison Project estimates show the Dutch share of global commerce shrinking as Amsterdam's docks grew quieter. Payroll records from the old VOC shipyards list fewer names each year. Wages, once the envy of Europe, flatlined. Merchants who had thrived on the spice trade now struggled to find new markets. The city's ledgers, once filled with profits, began to show mounting debts and overdue loans. The Dutch Republic, after a century of dominance, settled into a slow decline that no council decree or financial trick could reverse. Britain's own era of drift set in after the railway boom collapsed. Factory inspector reports from the 1850s describe unrest in Manchester and Leeds, loom workers and spinners complaining that their pay had not risen in years. Parliamentary papers confirm the pattern. Real wage growth for British workers stalled after 1870, even as the country's industrial rivals caught up. Imports from Germany and America chipped away at British markets. The empire remained vast, but behind the statistics, the pace of invention slowed, and the promise of boundless progress faded into routine. In the United States, the pattern repeats on a larger scale. After the 2008 bailout, asset prices recovered. But Bureau of Labor Statistics data show median wages barely budged through the 2010s. Productivity growth slowed, while household debt and federal deficits kept rising. IMF and the Federal Reserve charts track a widening gap between economic output and real incomes. For millions of Americans, the boom years felt distant, replaced by job insecurity and shrinking opportunities. Across centuries and continents, the aftermath of rescue is not a return to greatness, but a long era of disappointment, measured not in headlines, but in the quiet erosion of living standards and hope. The Dutch East India Company, once the pride of Amsterdam, ceased to exist on December 31, 1799. Liquidation records from the National Archive detail the handover. Every overseas territory, ship and warehouse was absorbed by the Dutch state. The company's debts, over 219 million guilders, far outweighed its assets. Bondholders received only a fraction of what they were owed, and many merchants saw their fortunes wiped out. For the Dutch elite, the collapse was both a financial and political reckoning. The merchant class lost its grip on power, and the state's burden of debt would haunt Dutch public finances for decades. Yet in this upheaval, the Dutch colonial system survived, reborn as a crown possession, its administration centralized, its profits redirected. Britain's reckoning came after World War II. For generations, the pound sterling had been the backbone of global trade. By 1944, it accounted for nearly 3/4 of official currency reserves worldwide. But war debts and the rise of the dollar eroded confidence. In 1947, the Treasury imposed strict capital controls, and sterling was made non-convertible. By 1948, its share of global reserves had collapsed below 40%. The Exchange Control Act and a deep devaluation in 1949 sealed the end of sterling's supremacy. British policymakers, once stewards of the world's money, found themselves managing decline. The loss of reserve status forced a painful adjustment in living standards and policy independence. Resets rarely arrive with warning. They sweep away old certainties, leaving debts to be written off, fortunes to vanish, and elites to be replaced. What survives is not the old order, but something new, often built from the wreckage. The Dutch and British stories reveal that renewal is never gentle. It comes only after the system's burdens become too great to bear, clearing the ground for the next chapter. The reset that follows is painful, and it clears space for new industries and new powers. Today, global debt stands at over $300 trillion, higher than any point in history. As financial cycles accelerate and new technologies fuel speculation, the old pattern remains stubbornly relevant. Empires do not collapse overnight. They erode from within, stage by stage. The warning is not in the past. It is in the choices we make now. What stage are we willing to recognize before the next reset? Share your thoughts below.